What is going on, penny boys and gals? How are y'all doing? And welcome to our options live trading stream. This is actually our first live options trading stream. I'm live with Swinging Bull, of course. How are we doing, Bull?
Pretty good. Good to see everybody.
Awesome. So as we can see, we do have our charts up. Looks like you are looking at, is that? I can't even see from here. That's SPY, I believe, correct?
Yep. Just looking at SPY. Had a little bit of a gap up this morning. Then it proceeded to sell off and fill the gap. But ever since the opening bell, SPY's been trending up pretty well. Kind of what we were anticipating is a little bit of a run up leading into inflation data that's being released this week. So let me just pull up the economic calendar. So tomorrow morning we have CPI inflation data. And then Wednesday morning, we have retail sales and PPI inflation data. So, we have the core inflation data being released this week. What I was anticipating is a little run up on the SPY leading up to the release of this inflation data. And then I do expect maybe some selling after that inflation data. And it's kind of all lining up. If SPY didn't kind of run today, maybe I'd be a little bullish going into it tomorrow. But sometimes with these economic reports, we'll see the initial move happen before the data gets released, but that's not actually the real move. So, we got a little bit of an uptrend on SPY right now. We'll see how it continues to trade throughout the rest of the trading day. But one of the option ideas that I have is it's about 12 noon Eastern right now. So I'm going to give it a couple more hours, and probably at the end of the day, I might enter some SPY lotto puts, okay, and emphasis on the lotto, all right, because we know on economic reports days, when they get announced, SPY really could do anything at that point. It's just going to depend on where the hedge funds and the big money is going to be moving their money around to. So it's definitely going to be a lotto play. But as far as the pre-plan for the play, things are working out. We are seeing SPY trend up, which is exactly what I wanted to happen. That way we could pick up the puts at a fairly cheap price at the top of the range for today. Leading in tomorrow, definitely going to be a lotto play, but I'm going to go puts. And the contract I was looking at, of course, SPY has many expiration dates to choose from, but I'm probably going to just be looking at the Friday, March 17th expiration date. And as you can see, they are kind of affordable. They're not too expensive, but I'm probably going to be looking at scooping up some of the 380 puts. They're selling for about $285 right now. If you wanted something a little bit more affordable, maybe the 376 puts, they still have a delta of 22, gamma 0.012, basically $2 there. So 376 if you're looking for something a little more affordable, but I do like the 380s, a little bit closer to the money. I'm probably going to scoop these up this afternoon, just watching the price of SPY. Because if it keeps on pumping today, we want to try and buy the puts at the highest possible point. That way that the puts are going to be really affordable. And then we'll just hold them overnight. And then when inflation data gets released tomorrow morning, hopefully we'll get a nice little payday out of that, and we'll go from there.
Nice. I know that in the premium Discord, we have a bunch of options, swing alerts. We have day trades as well. One that Amy Amajama, one of our analysts, has been playing has been GE. Have you been playing or watching it at all today for this week? I know that she's been doing some swing trades. I believe that she stopped out of the first one, but now is building down position as far as this market goes, according to this market. When it comes to these kind of plays, like, a play like GE where you get into it, might not have worked out, hit your stop. How do you know when it is time to re-enter or just time to let it go?
Well, I mean, typically before we enter these options trades, we want to know how much we're going to be risking. Okay, we should be able to identify that before we even get into the trade, and then we need to have our risk management set. So if I say to myself, well, I'm going to get into a GE trade, and I'm only going to allocate up to $500. Okay, if I'm saying that to myself before I enter the trade, there's no reason why after I get into the trade, why we should be changing that. Basically, we shouldn't be turning a $500 trade into a $1,000 trade halfway through the trade, when that wasn't the plan to begin with. So if you find yourself doing stuff like that, you probably want to take a step back and kind of reevaluate what you're doing, because you're trading your plan halfway through the trade, when you should have just stuck to the original plan. Because a lot of times what happens, most people will end up putting more into the trade than they originally intended on, because the trade's moving against them. Okay, and that's the main reason why people turn a $500 trade into a $1,000 trade. You shouldn't be doing that, because if you are, the loss that you would have taken on the $500 trade is going to be a lot less than the loss you're probably about to take since you increased it to $1,000. So number one, just stick to your plan. If you said to yourself you're only putting in a certain amount into the trade before you enter the trade, and then you enter the trade, don't change how much your total allocation is going to be. You're already taking 2 steps back when you start doing stuff like that. And then number two, have your stop loss in play. For me, when I'm day trading, 20% stop loss on an option, I think, is ideal. And again, as long as we're winning more trades than we're losing, and keeping our risk management in place. So at least, try to have a 1-to-1 risk to reward, where, okay, if I tell myself I'm going to take a 20% stop loss if it moves against me, well, then at least try and shoot for a 20% gain. That way, at the end of the day, as long as we're winning more than 50% of our trades, we should still be net positive at the end of the month. So that's kind of how I determine when I'm, when I'm going to get out of a trade if it moves against me. It's very simple. Just keep a 20% stop loss. If it doesn't work out, it doesn't work out. Move on to the next trade. Don't start justifying reasons why you should stay in a trade if it's gone against you. A lot of traders do that too.
That is so true. I mean, emotions, especially when it comes to options trading, it's a high risk, high reward type of trading. Emotions and trading psychology is super important to keep in mind. We have Babu Chris in the chat saying how they got into GE. It's got stopped out this morning. It sucks because it's the only play they got into today. When it comes to those, these losing plays, because they do happen. And sometimes, especially for new traders, they happen more so than the winning plays will happen. And that's okay. When you first learn to ride a bike, obviously if you don't have your training wheels on, there's a good chance you're going to fall if the first couple of times you get on there, but then eventually you'll get used to it. Same deal goes with trading. Just don't be discouraged when you get those like first 1 or 2 losses, especially on a Monday, beginning the market. But the really important thing is not to revenge trade. So like Bull was saying, once you had that first loss, it's important not to just try to make that money back in that particular stock, or just in general. Like if you don't see a trade, like a great setup, don't force it just to try to make your money back. That's super, super important, especially in options trading, especially in a market as volatile as this one. And Bull, I know on the bottom of the screen, it says that coming up, we're going to be talking about some options spread trading education. For those of you watching, we'll be doing that around the halfway mark, just going over some tips and tricks from the Swinging Bull as far as options spread trading. A really, really, really great technique to use. I know that you, Bull, you said that you actually use that more often than not, right?
Yeah, I mean, spreads is basically my main trading strategy, because it kind of takes some of the guesswork out of it. A lot of the spread strategies I use could be considered a neutral strategy, which means, I don't care if the stock goes up, down, even if it goes against me a little bit. Usually my short strikes are pretty far out of the money, where it gives me a little bit of cushion where the stock could trade in the range. And basically I'm capitalizing on theta decay to capture the premium that I collect when I sell the options. But the spreads, we deep dive into that in our premium section. I do streams every week about spreads, and the premium members love it. They gobble it up. But since we're in the free section today, we can definitely, like you say, like around halftime or midway through the stream, we can definitely talk about some covered calls. I think that's a pretty, it might not be basic if you've never heard of it, but I think it's one of the more basic selling options strategy is covered calls, because what we're doing is we're using stock that we already own. Okay, we already own the stock. And it's a way to generate income off stock that we already own. So for every 100 shares of a stock that you own, if it has options on the underlying, for every 100 shares, we could actually write a contract and sell it instead of buying it. It's just something you can do on stock that you already own. Maybe you're red a little bit on the stock that you already own. But just keep in mind, for every 100 shares, we could sell some options to collect some premium to reduce our cost basis on the shares that we own. So we'll definitely talk about that later in the show.
Yeah, it's interesting when it comes to options trading. It's so there's so much more than just learning about the Greeks and just buying a premium, selling a premium for profit. Like there's just so many different strategies out there. Like we were talking about spreads, iron condors, covered calls, and a lot of these strategies are ways to limit your risk. And also for some of them limits your potential reward. But especially for new options traders getting into this market, it is really, really, really important to know how to use all the different tools available to limit your risk and to trade these options successfully.
Yeah.
Or at least according to your plan. Let's get back to the chart. So I'm going to go ahead and bring your
Yeah.
chart back up because I know that people here are eagerly looking at some plays to swing this week. So I know that you are the swinging bull. You aren't huge into day trading options, which I don't blame you. That's how I blew up my account more than once when it comes to day trading options. Now, if I'm going to be day trading, I'm going to be doing it with a small portion of my account. So let's talk about some options that you might be swinging into this week. I know it is Monday. Options expire at the end of the week on Friday. So what are you looking at as far as the options market goes, Bull?
Yeah. So, one of the trade setups that I'm looking at right now, it's panning out. I haven't entered the trade yet, but that's why we kind of have a pre-game plan before we enter trades. We're basically being patient and waiting on the setup to come to us, and then we can go ahead and enter the trade. Instead of trying to predict the market and have our little magic 8 ball out and, which direction is the SPY going to go today? And you shake the 8 ball, is it going up or down? I don't really like doing that. So I kind of wait for the setups to come to me. And one trade that I think is going to be good, that we could go ahead and enter probably later today is I got the daily chart of SPY pulled up, and I do have some levels on the chart. And these levels came from a Fibonacci retracement that I put on this chart here. And it's basically the 346 low that we had from October of last year, and just draw the Fibonacci from that low point all the way up to the high point here at 418.31. Which was the high that it hit in early February. And once you draw that out, we have some pretty good levels that we could maybe formulate a game plan off of. And one level there's two levels that are important. And the first level we were talking about last week, which was the low 390s. Okay. We knew last week, I was talking with Amy and Lee about this, some of the other analysts last week. And we knew that we kind of needed to hold the low 390s for a potential retracement to the upside. And we just couldn't hold it. Okay. Last Friday had a big red candle, basically dropped below that level Friday morning. And then we ended up closing, down in the mid 380s. So we lost that low 390 level. The level below that is the low 380s. All right. So now we have two levels to play off of for a potential play. Since we lost the low 390s, well, we know that support, because it was support, is now turned into resistance. Okay. And looking at the price action from today, we did dip down to the low 380s, which was the next level to the downside. We've since had an impulse move to the upside. And this candle, this green candle, this is a daily candle. So this whole candle is from today's price action. But we dipped down to the low 380s, impulse move to the upside today, which is what I was hoping for. I actually wanted that to happen because we know that this low 390 support turned into resistance. And that's kind of been what's going on today is we've gotten up to the low 390 again. Bit of a wick on the upside of this daily candle, which tells us there's sellers up here waiting. And every time the price gets up there, it gets pushed down. My strategy, and this is strictly a lotto play, you guys, don't put all your eggs in one basket on this one. But I'm going to see how the price action acts for the remainder of the day. It's about 12:17 p.m. Eastern. So a little bit later on this afternoon, if SPY's up around the low 390 resistance, I think this is going to be a good lotto play to pick up some SPY puts. And again, I'm going to be looking at this Friday's expiration. No need to put a bunch of time on this because the economic data for inflation, at least for the PPI, or I'm sorry, tomorrow's CPI, that comes out tomorrow morning. So the move that we're looking for is going to happen tomorrow morning. So I'm liking what I'm seeing by SPY uptrending today, because as soon as we get closer, I mean, we're kind of there now. I'm just going to give it a couple more hours just in case it wants to pump a little bit more today, in anticipation of the inflation data tomorrow. But I'm thinking this afternoon might be a good lotto play to maybe just pick up. I was looking at the 380 puts. 380 puts could be a good bet, or the 370, maybe 375s might even work. So 375s or the 380s. The 375s would be a little bit more affordable. But if everything goes as planned, I'm hoping that we'll take some nice profit on this tomorrow morning. And yes, I did use the word hope. The only reason why I said that is because this is a lotto play. All right. This is not some fantastical due diligence, fundamental swing play. This is totally a lotto play. And we're trying to take advantage of the volatility of the inflation data being released tomorrow morning.
No, I love it. And that's really important to keep in mind that this is, once again, a lotto play, very, very, very high risk. And you're looking at, once again, at SPY. If up around that $390 resistance, you're going to be looking at some puts with the end of week Friday expiration, in hopes to play that catalyst tomorrow, which is, you said, the CPI data?
Yeah, yep. It's the inflation
Awesome.
data, and it's going to be the CPI data. And another thing, just so we cover all bases, because we do have some bulls. I know my name's the swinging bull, but I am bearish going into tomorrow. But for the bulls scenario, just keep in mind this low 390. Okay, that is now resistance. It used to be support last week, but now it's resistance. If we are bullish tomorrow and investors react positively to the inflation data, and we do push above the low 390s and hold, for the bulls, I'm definitely going to be expecting a move to the mid 390s, if not more, maybe even a retest of 400. That's going to be the bull case if that happens. And let's just, again, this is a lotto, okay? So it could go either way. It's just going to depend on big money sentiment and their reaction to the inflation data. But if it ends up being a bullish day, and tomorrow morning after the inflation data gets released, and SPY makes a move above the 390s and holds there in the morning, I will be expecting a push at least to the mid 390s, maybe even test the 400s again. And if that's the case, expiration date, okay, for Friday, we'll go ahead and stick with that expiration date. And then I think easily probably buying the 395 puts, selling for about $225 right now. I'd go with the 395 put. Still has a pretty nice delta at 30. Even if you wanted to go closer to a delta of 20, the 400s have a delta of 15. I'd probably go like 398 puts, which is only selling for $130. So that's a little more affordable for the smaller accounts there. So if we just wanted to state my bull case, because I like to have a plan, whether it goes up or down. That way, it doesn't matter if it goes up or down. We have a plan for both ways. So bearish, I'm going to go for the 380 puts. And that's going to be a lotto for today, 380 puts or 375 puts. I'm not going to do a call lotto because I'm already doing the put lotto, but I will have a plan. If my put lotto doesn't work out, then tomorrow morning, obviously the put lotto is not going to work out because we're bullish. Then tomorrow morning when the bell rings, I'll be looking to enter the 395 calls or the 400 calls, or I'm sorry, 398 calls or 395 calls, assuming my lotto put goes against me, and after the opening bell tomorrow morning, SPY holds above the low 390s. I do think we'll get a push to the upside, and I'll be looking at the 395 calls or 398 calls.
So that's interesting. So if the lotto put overnight does not work out, you'd be actually looking at calls in the morning. If
flip it,
if you're going to flip it basically in the morning. Yep. So when it comes to the lotto puts, I know you're saying you're not going to be doing that exactly right now. When, for the traders who are listening to this stream, they might be wondering, when do I buy these puts? When would be a good time to look at these puts? Would it be right before market close? Would it be based off the technical analysis? Or how do you know when to pull that trigger for those lottos?
Yeah, I'm gonna wait a couple more hours here. We got about 3.5 hours left until the regular session closes. So I'm gonna give it a couple more hours. I'm gonna see what the price is doing, probably around 2 p.m. So about an hour and a half. I'm really gonna be getting into the mode of pulling the trigger on these lotto puts, and I'll alert it in the premium Discord
Cool.
and everything for everybody. But this afternoon sometime, I'm looking for this level to hold here, which is basically the bottom of this consolidation that we've been having. This is the 3-minute chart. You can see every time the wicks come down to this level, the buyers step into the picture and kind of hold it up above this level. So, if SPY's above like 387 area this afternoon, or even better if it's a little bit higher, because that means we'll get the puts cheaper. That's when I'm going to pull the trigger on these put lottos.
Gotcha.
So I am biased as a bear for tomorrow morning. That's why I'm only doing the put side for the lottos. But I do have a contingency plan where if these put lottos move against me when the opening bell happens tomorrow morning, and if investors take the inflation data positively and we end up bullish for the day, I'll be entering calls for a move of SPY to like mid 390s, possibly retest of 400.
Gotcha. I want to get into a little bit later after we do the covered calls education part of this stream. I want to kind of get into what you look to when it comes to the different premiums, the different expiration days. So when it comes to these lotto plays, just option calls in general. As an analyst, how you decide which which premium and which expiration date to take. But before that, and this will be the last thing before we do our educational section of this stream. I'm looking at a tweet here from a very big Twitter presence in the financial world. Actually, our own BTCJ. Jay was able to go on a stream with I think it's around 500 or 600 people there to give his market analysis, and he did such a good job that he got invited back for next Wednesday, which is awesome. So
Nice.
I'll be posting that in the Discord, so y'all can tune into that. But this person is talking about 10 different stocks they're holding for the next 10 years. This is a, like I said, Twitter influencer. They were actually at the bell ring for the stock exchange the other day. They were talking about Apple, Google, Microsoft. They have Amazon, Disney, Nvidia, Tesla, among others. When it comes to some long-term, 10-year holds, which I know, in these markets, there are a lot more traders than there are long-term investors, but bull markets, are also opportunity markets. Are there any stocks that you are, I wouldn't say 100%, but very, very confident that it could look better in 10 years time from now, and people, start buying them now, or even looking at some very, very, very long-term option plays, they could be safe bets. I know, once again, they were talking about a lot of the blue chips, Apple, Google, Microsoft, Amazon. What are some really long-term plays? I know Tesla's a very popular one that you're looking at, Bull.
Yeah, I mean, I mainly trade the blue chip stocks. Okay, my trading strategy is very easy. I look for different fundamentals in the company that for whoever's taking notes, some of the things that I look for is I like really good ratios, and when I say really good, I'm not talking about 7,500 PE ratio. I like my PE ratios to be in the 20s, maybe 30s. That's a comfortable area there. If you pull up a company and they have a PE ratio of like 80 or 100, just keep in mind that that could be considered overvalued by a lot of investors with the PE price to earnings ratio that high. And so there could be some pullback on those stocks with those very high PE ratios, especially when economic times are kind of uncertain. So we're trying to go to safe bets here. So one thing I look at is a PE ratio around the 20s. I prefer it like around the 20s. Perfect example is Apple. Their trailing 12-month PE ratio and current PE ratio is right at 25. So I love that. Apple's such a great company for the long term. You guys, they do pay a dividend, so I really like that. And I'm also looking for companies that have decent sized market caps. I prefer the companies to at least have a market cap of 250 million or more. When the market caps are below that, that's kind of when we're getting into penny stock land and things of that nature. Another thing I like to look for stocks that I would like to hold long term, or they're going in my Vanguard retirement account or something like that, are stocks with positive EPS, earnings per share. I think that needs to be positive. So just two metrics that you could easily find on any broker, key statistics. realistic area. Just look for some positive PE ratios and positive EPS, I think are important. Even a bonus if they have a dividend, because now we're collecting passive income on the stocks that we own. Another metric that I look at is definitely going to be positive net income, you guys. Okay, don't overcomplicate these things. We want to make sure that at the end of the day that the company is profitable. Okay. If they have now, just keep in mind they could have positive total revenue, as I'm showing on my screen here. They could have positive total revenue, but the metric we really want to be looking at is the net income, because they could have positive total revenue, but maybe their overhead or margins are just through the roof, and they're not profitable at the end of the day. So the net income, you can look at the annual for a bigger picture, quarterly if you want to kind of get a little bit of a more in-depth view, but positive net income on the annual metric is going to be something that I'm personally looking for, because I want to make sure these companies are profitable. So just a couple things that I look for, among other things. And I know we're limited on time here. I mean, I could talk about this all day on some of the other things but just some really easy things that you guys can just make a note. If you want to hold these things for years, as Duck says, 5-10 years, just make sure that fundamentally that the company's above water. I mean, that's going to be number one you should be looking at.
And I think we'll me and you will get together. We'll work on making like a nice checklist for long-term stocks. Like I know, because I know everyone's talking about the checklist when it comes to recession or bear markets happening, and every stock influencer out there is showing all the different checks. Well, I think it's also good to make like a checklist for this is a long-term stock that I'm looking at, and these are the different criteria I can see if it's a strong company. So that's something we're definitely going to be putting in the Penny Boys Premium area for the education, Penny Boys University. I am going to drop the link to the YouTube in the free live stream chat. We're going to be posting, this is the YouTube to the live stream. I am going to be playing a video in the YouTube. So those of you who are watching on Discord it'll just be kind of like quiet for you guys. So definitely make sure to check out that YouTube link. I'm going to post it right now. We're going to be playing an options trading education class. This is like a 3-minute clip. And that's going to be on covered calls. And then after that, we'll be picking Swinging Bull's brain when it comes to covered calls. So make sure to join that YouTube. I'll give y'all like a minute or two to join us so y'all can be a part of the little clip that's going on strictly in the YouTube. We got Doctor in the YouTube. Oh snap, the dream team, Bull and Duck. I love it. Doctor. Yeah, we're gonna be doing these every Monday. I know me and Bull haven't been live for in a while together, so we're gonna be doing this every Monday at 12 p.m. Eastern, just going over the different stocks and options that Swinging Bull is
we might be a little rusty, but we'll add some WD-40 and we'll get right back to the good old days.
Yeah. You wait and see. Give it a month or two, and then we'll be cruising along these. But yeah, I'm gonna go ahead and play that halftime video. That's gonna be once again a covered call. What's going on? Hello, I'm Kayla. Covered call options class, and for those of you in the Discord, it is in the free live stream chat. You can check it out. So let's go ahead and watch that, and then we will be picking your brain bowl as far as what all this stuff means.
Sounds good.
All right. You know that covered calls can help you try to limit your losses in options trading? Well, if that's news to you, then you're in luck, because this class we'll be talking all about covered calls. I'm Adam Matt, Director of Education at Penny Boys University, and welcome to class number 14 of Penny Boys University Lite. This is class 4 in a 10-class series in options trading, part of PBU Lite, which is 100% free. Make sure to check the description in this video for the handout as well as a class video game. One way to use options is to write covered calls to try to limit your losses. A covered call is a strategy where I own 100 shares of a stock and decide to write, meaning sell, like we talked about last class, a call option on the same stock. So I'm selling the option to buy a stock at a certain price by a certain date for a stock I actually already own. So I receive the premium for selling the call option. If the stock price stays below the strike price of the call option, the option will expire worthless, and I will keep the premium as profit. So in theory, if the stock goes down and I decide to sell my 100 shares of stock for a loss, the money I made from the call's premium expiring worthless will help offset that loss. So for example, let's say that you buy 100 shares of stock XYZ at $30 per share. So that's $3,000 you spent for that 100 shares. You don't believe that the stock is going to go up higher than $35 per share within the next month. So you decide to write or sell a call option with a strike price of $35 and an expiration date of 1 month from now. You receive the premium for selling the call option. Let's say the premium is $1 per share, so you get $100 for writing the call option. If the stock price stays below $35 at the expiration of the option will expire worthless, and you will keep the premium of $100 as profit. So the stock goes down to $29 by the end of the month. Your 100 shares that you bought for $30 each at a total of $3,000 are now worth $29 per share at a total of $2,900. So you are now at a $100 loss on your shares. However, since the option contract you wrote or sold with a $35 strike price expired worthless, you keep the $100 premium, so it balances out your potential loss. So when writing a covered call, it is important to know the difference between at the money, ATM, in the money, ITM, and out of the money, OTM. If the strike price is set the same as the current stock price, the option is considered to be at the money for both calls and puts. For calls, in the money are contracts that are lower than the strike price, and out of the money are contracts that are higher than the strike price. For puts, it's the opposite. So basically, in the money means it wouldn't expire worthless if the stock price stayed the same. So basically, in the money means that the option would not expire worthless if the stock price stayed the same as it currently is by the end of expiration. And out of the money means that it would expire worthless if the stock price were to stay the same by the time that expiration happens. So for contracts that are in the money, the premium received for writing the option will typically be higher compared to writing an out of the money option. However, the farther in the money you go, the more likely it will be exercised. So what happens if your covered call is exercised? Well, if the stock price goes above the strike price, so in our example earlier where I bought 100 shares of a stock at $30 and wrote an options call with a strike price of $35 with an expiration a month away, if that month goes by and the stock price goes above $35, let's say to $40, the option buyer may exercise the option that I wrote, forcing me to sell my 100 shares at the strike price of $35, even though the stock is currently trading at $40. So instead of selling 100 shares at $40 per share for a profit of $10 per share or $1,000, I'm instead selling my 100 shares at $35 per share per the options call contract for a profit of $5 per share, so $500 profit. Plus, I still keep that premium of $100, so that's a $600 total profit, but I missed out on $400. So covered calls can limit your losses by letting you keep the premium. However, it can also limit your profits by making you exercise the contract. The covered call is a low-risk strategy as the investor already owns the stock, reducing exposure to the market fluctuations. However, like most things in trading, it has to be done properly to truly work out and is not recommended to brand new options traders, but it's a good tool to be aware of. Spread trading is another popular strategy used by options traders to make money by taking advantage of the difference in price between two options contracts. Make sure to tune into class number 15 where we talk all about spread trading. We also have a complete options 101 class in our free trading Discord, as well as an advanced options strategies 102 class in the premium area of the Discord, as well as educational options trading live streams with Q&A with veteran traders. I hope to see you all there, but until then, I hope that you all make some bread. All right, so that was our options covered call class. So now, Bull, that was the very, very basics PBU like class. For those of you who don't know, we do have those all available in the options series channel of the Discord. There's an 11 class series, all going over options, all 100% free, but they are the basics. So I want to kind of step it up a notch. That was the basics. So Bull, when it comes to covered calls, when it comes to that strategy, how do you personally use it? What is the best way to use it? How do you know when to use it? Because I know you've been doing it in the market for years now, and you definitely are one of our top options traders as far as all these types of strategies go. So I'd love to hear from you when it comes to covered calls. What is a covered call to you?
Yeah, basically what I use covered calls for is to reduce my cost basis on shares I already own. Okay, so for instance, if I owned shares at Apple, and let's say maybe I scooped them up before this bull run we just had, because Apple was just trading at $123 not too long ago, about 2 months ago. Let's say I jumped in with the buyers here, waited for confirmation that buyers were stepping in, to make sure that the selling has stopped. So let's say, perfect example here. Let's say I jumped into Apple, let's just say about 135 bucks, and let's say I had 100 shares. So either jumping in here at 135, or let's say just over the years I've accumulated 100 shares of Apple, and let's say my cost basis is 135. What I use covered calls for at that point is to reduce my cost basis on shares that I already own. So for instance, we got a clear top on Apple here at about 155. It's about the mid 150s. We could see it right here on this daily chart. Go ahead and put a horizontal line there. Bam. Right. So we know there's resistance here. So the idea behind it is because I want to keep my shares of Apple. Don't just sell a random covered call at a random place on the chart, because in the long run, we want to keep our shares. Okay.
So you're saying for covered calls, make sure to only do them if it's stocks that you're confident in long term. You want to actually hold on to the shares.
That's what I use it for.
For you personally,
Um,
gotcha.
yeah, because I'm using it to reduce my cost basis on shares I already own. So, for instance, say my cost basis is 135 bucks on Apple, and I just so happen I have 100 shares. I'm going to look at the chart, and I'm going to sell a covered call above the resistance. The beautiful thing about this Apple chart right now is the price is right by the resistance. The reason why that's beautiful is the premiums on the calls are going to be fantastic, especially the strike right above this resistance. I mean, we could even put a little cushion on there to have a little more confidence that our shares are not going to get called away. Let's say we sell the $160 covered call on Apple. The way I set the trade up is I do like to have about 30 days of time on the covered call contract before I write the contract and sell it to somebody. Okay. So we could just go out to this April 14th is a weekly cycle. That's 32 days out. We can kind of look at the volume going on this over here. Sure enough, the 160 call has about 520 volume on it for today alone. So we can go ahead and stick with that. Now you'll notice when I sell this $160 covered call, I can collect about $230 in income off this covered call when I sell it to somebody. As long as Apple stays below 160 by the expiration date, we will realize 100% of that credit. We could of course buy that back before expiration. Maybe when we hit 50% of the max gains, we can go ahead and capture 115 bucks. And close out the position, take the risk off the table. Just depends how you feel about the trade. But if you were to keep it until expiration, collect $230. So on the option chain, it's $2.30, but we all know that's times 100 in options. So I'm collecting 230 bucks. The interesting
thing, Bull, really quick for those listening. So when you say you're collecting it, what you mean is you're basically short selling. You're selling the contract that you don't currently own, collecting the money for selling it. But now you basically, because you sold it and you don't own it, now you owe basically, you need to basically cover the stock and eventually give it back to the lender, correct?
No.
Because the hope is that it expires worthless. Yeah. You don't have to, right?
Yeah. I mean, as long as Apple stays below 160, my shares are going to sit right in my account and they're not going nowhere.
Right.
But the shares are there in case Apple goes above 160 at expiration. Then yes, my shares will get called away. 100 shares for each contract, but we've still collected $230. And if my cost basis was only $135, now I just profited 160 minus 135. I just profited $25 per share as well. So do the math with that, 25 times 100. So I just made $2,500 on the trade plus the $230 I collected when I sold it. So one thing I did want to point out is if your cost basis is $135 and you sell the 160 covered call and it expires worthless and we keep 100% of that $230, we then can subtract that $2.30 from our cost basis. So now at the end of the day, our previous cost basis was 135. Well, we collected 230 when we sold that covered call. Our new cost basis is now only $132.70. So in theory, we could keep selling covered calls, continually reducing our cost basis. I mean, I know people that do this, that reduce their cost basis to zero, and they literally have a free 100 shares of the company at the end of the year. So that's called running the wheel. so to speak. That would be completing the wheel. The first part of the wheel is obviously selling cash secured puts to get into the underlying stock at a discount. And then if we do get assigned the shares, then we start selling the covered calls. But the back half of the wheel, which is the covered calls that we're talking about today, if you're good with technical analysis and you're placing your covered calls above resistance points, you could just keep doing this every month. And then, we'll just take this same example, $230. I mean, imagine if you did that 10 times, 2.3 times 10, you at the end of the year or at the end of 10 months, because we're running on monthly cycles, initially you had a cost basis at $135. At the end of 10 months, you could have a cost basis of $112 on Apple. Can you believe it?
Hmm.
And that's where the magic is. That's where it makes the strategy beautiful. You could just keep doing it over and over, collecting premium, and each time you collect premium, you're reducing your cost basis. And I talk about covered calls a lot, especially with traders that might be per se holding a bag. Okay, one of the first things we could do, obviously, if they're holding a bag. They probably have more than 100 shares because they've probably been adding to the position over time, hoping that the stock bounces back into their favor. Sometimes, a lot of times that just doesn't happen. But if you're red on the position, one way to reduce your cost basis to get you back closer to at least break even is to sell the covered calls on that position, assuming that the underlying stock has an options chain and there's an ability to collect premium. So that's one way to kind of salvage a losing position that you've been building over time, and you've been trying to average down to get closer to the current price, and maybe you're still red on it. Well, maybe you're sitting on 500 shares. Well, maybe it's time to start selling covered calls, and with 500 shares, you can write 5 contracts and collect the premium times 5.
Awesome. And for those of you who are listening and you want to know more about covered calls and just options strategies in general, we do have an options class in the premium section of our Discord. And we have our live PBU lives with Swinging Bull with our premium members. And during one of those, he goes over options trading in full. It's like a full hour-long class, all about options. Definitely worth checking that out. Those
Tuesdays
are on
at 3 p.m.
Tuesdays, right?
Eastern.
Tuesday,
Yeah.
3 p.m. Eastern. Yep. And then you also have your PBU live on Mondays, I believe. Those are definitely worth checking out as well. But yeah, we're hitting the last couple of minutes of the stream. We're at the 45-minute point. And I know we want to keep this around that 45-minute area. Last thing I want to ask you when it comes to options trading, is there anything that you're looking at as far as banks go? I know with the Silicon Valley Bank, they pulled a little bit of an FTX, but with bonds instead of YOLOing on meme coins like Sam did, Sam Bankole did. But yeah, so as you know, this whole Silicon Valley Bank thing, everything took a huge hit. A lot of banks took hits. A lot of tech companies, startup companies were taking hits. Is there anything, because obviously we as traders, maybe not investors, don't like it when when these kind of events happens, but for traders, we love volatility. We love opportunities. So are there any options or just trading in general opportunities that you're looking at as a fallout of the collapse of Silicon Valley Bank, the second largest collapse in banks in the history of America?
Yeah, I mean, everything that went down with Silicon Valley, I mean, the FDIC literally raided their offices and basically took over operations. Since then, they've assigned a receiver to kind of deal with the fallout. President Biden did have a press conference over the weekend, basically stating that they're going to cover all deposits with SVB. I don't think they're going to cover all deposits on all the other banks, but I do think they're going to step in for Silicon Valley Bank. Now, some of the other banks have been taking a hit alongside Silicon Valley, and a couple key ones to keep note is Signature Bank. FDIC did step into their offices, I believe over the weekend or late last Friday, and basically, taking everything over. Kind of similar situation. They'll probably assign a receiver as well to that one. So Signature Bank took a hit. Another one, I believe, was First Republic bank. I believe it's out of LA. That there was a line of people at the ATM wrapped around the building. Everyone scurrying over there to pull their money out. Now, the thing I do want to point out, if you're trying to trade this banking crisis that's going on right now, it's going to be tough because, as you can see, I'm on Signature Bank right now. They are currently suspended. There are a lot of other banks that I believe are halted or suspended. We can pull up First Republic here. First Republic is still trading. I mean, last Friday, this bank was at $75 a share, and it hit a low of $17 this morning. First Republic is taking a beating. They're down over 60% right now. The thing is some of these moves happen in extended hours. So there were people, investors that woke up this morning and they're like, "Oh, I'm just going to short all the banks." Well, they kind of missed a big chunk of the move in pre-market. So be careful chasing them. Big money likes to make their moves when they know there's not a lot of retail traders active in the market. Hence why you see a lot of these dumps in hours where you can't trade options. These are investors dumping the shares here. So we did have a little bit of a sell-off this morning that you probably could have taken advantage of right here as soon as price broke below VWAP on First Republic. This is ticker symbol FRC. There definitely was a nice put opportunity there. They do have an option chain you could have taken advantage of. But as you can see, it kind of rebounded and it's kind of trading sideways here. So my main concern with trying to play this bank mess that's going on right now is you don't want to find yourself entering a position in one of these banks and then one of these things happen, like what happened with Signature Bank. You're in the position and now the ticker is suspended or halted and you literally can't do anything about it. That would be my main concern, Duck, on playing and trying to get involved in this banking action, is you could get caught in a position and you literally can't do nothing about it. I mean, it's trading at $70 right now, suspended. When this thing gets unsuspended, if it ever does, I mean, this thing could be at $10.
Right.
Now that's good if you have a short position. That's good if you have a short position, but how long is it going to take to get unsuspended? And how much theta decay is going to eat away at that contract while it's suspended, possibly blowing your whole short position up if it's an option. So just a couple things to keep in mind. Very risky trying to catch a piece of this bank thing going on right now.
Are you looking at any like tech stocks or startups? As I know everyone's looking at the banks, but there's a lot of stocks that are affected that aren't just the banks, by Silicon Valley, especially a lot of tech startup companies who were who are using them, using the banking systems, and now a lot of them are, only going to be getting, for now, up to $250,000 as the FDIC does insure any bank, which is, up to $250,000. They are going to be getting, I believe, like dividends and some type of certificate. I believe everyone will eventually be made whole again. This isn't FTX, this isn't crypto. This is a bank, with the FDIC and regulations. It's been around for a while. Not the first bank crash either. Like I think the longest span that we've gone without a crash, obviously not to this proportion, but was between 2004 and 2007. That's the longest span without a crash of banks. So it's not a long time.
And then 08 hit.
And then 08 hit. So yeah, exactly. So, but now we're also looking at the the U.S. government debt markets. You were just talking about CPI inflation earlier. I believe that the debt market experienced the biggest move since the Black Monday in 1987. So basically, that was like one of the most severe market crashes on record. That's basically the 2-year Treasury yield, which is very sensitive to changes in interest rate expectations, fell 0.54 percentage points in morning trading this morning to just above 4%. Once again, that's the biggest one-day drop since October 1987. And I know that people were already talking about recession, the end is near, and all that. Are you too worried, or are you just going to keep trading the way you normally trade even after this big crash, or this big crash of the bank crash?
Yeah, I mean, speaking of the yields on the Treasury bonds, one thing to keep note is in an ideal market, usually the 10-year pays more than the 2-year, and the reason why that is so is because basically in 10 years there's more uncertainty. So wherever the uncertainty lies, that's usually going to yield the most amount of money. So in an ideal market, typically the 10-year pays more and the 2-year pays less. What we've been seeing is a yield inversion, which means the 2-year is paying more than the 10-year. What's that tell you? Where the uncertainty lays? It lays in the near term. So an interesting stat is we had a 2-year, 10-year yield inversion where the 2-year pays more than the 10. That's where the inversion happens. We've had that inversion has preceded the past 8 recessions. So that tells you what, we're in the middle of a yield inversion right now. If according to history, we've had the same exact yield inversion precede the past 8 recessions. So I do think we probably are heading towards a recession. Does that happen this year? Does that happen next year? Looking at the charts of when it happened before, it could take up to 18 months to happen once the yield inversion occurs, and the yields are inverted right now. So just a little tidbit of information there that we've had this yield inversion and it's preceded the past 8 recessions. I'm bearish for the foreseeable future.
Oh yeah.
And I think interest rate hikes are going to continue to happen throughout the rest of 2023. I don't think the Feds are going to pivot until next year.
Right. So, Bull, we got one question left. We got one more minute left. So we'll make this a minute answer. But I'm really curious. I'm very heavily involved in the NFT and crypto Twitter space. I see a lot of crypto and NFT influencers. When this big crash happened with the with the banking system, with a bank, everyone in the crypto, all these crypto influencers and NFT influencers, like, oh look, everyone was saying this, that, whatever about FTX, but it looks like banks can do that too. I mean, it's a very, to me personally, I think there's a very big difference between what happened with FTX and what happened here. I mean, one was, basically some guy, some fake philanthropist, like literally playing around people's money. This other one was a bank doing what banks do and putting money into bonds. And then, and then the market took a hit. It's not like they're playing around, like putting all their investors' money into Dogecoin or, AMC or some penny stocks or whatever. And the other big difference, of course, is the FDIC. There's a lot of people in FTX who just didn't get any of their money back. Of course, right. The FDIC does insure up to $250,000. So people who had anything less than that are, is going to be getting their money back relatively soon, I believe, too. So if let's just say you had $500,000, that's more than the $250K FDIC insurance, and you had to, and obviously we don't go 100% in on any market, but let's just say you had to put $500,000 into something, whether it be a stock, the markets, maybe like an ETF. It could be crypto, it could be NFTs, it could be gold, it could be toilet paper, it could be eggs, whatever. What do you think is this? Because everyone's talking about how the banks aren't safe anymore, fiat's not safe, crypto's not safe. What is safe? Everyone's like, oh, put money into eggs or whatever. Like what would you be putting your money into? And besides underneath your couch, of course. If you had $500,000, what's the safest play for you?
I probably buy I bonds. I bonds are paying, I think they're paying 5%. For a 6-month I bond. That would be one option. Another option, for me personally, where I have a lot of my cash now, it's not in a particular stock. Okay. Actually, it's in a settlement account with Vanguard. Okay. Vanguard's not going anywhere. Vanguard has been around for, I don't know, 100 years or more. One of the biggest financial and stable financial institutions I think there are out there. Fidelity would be a close second, I think. But Vanguard, I currently have funds in a settlement account, and it's basically just sitting in all cash, and they're paying me a little over 4% annual, and this 4% is compounded monthly. So I actually get a dividend every month, which compounds. So it's actually a lot more than 4% after the compounding effect takes hold. That's where most of my cash is sitting. I get a nice dividend every month on cash. Wow. That's what's safe for me. And again, bonds are paying really good now, and that's basically guaranteed money with the federal government. So that's where my money's at. It's not in a particular stock, and I don't have to trade it. and it's just sitting there compounding monthly on a 4 to 5% annual return through Vanguard.
Vanguard, yeah,
Yes,
Kayla,
Taylor, that's correct. And
that's awesome.
that's just the settlement account where your money sits waiting on it to be traded. But you don't have to trade it. Just leave it there and collect that compounded, collect that it's a little over 4%. Mine increased. I'm not sure if they have a special deal depending on how long you've had your account with them, but I think mine increased just along with the rest of the interest rates increasing because they were paying me like 3.7 and then it went to 4 something. But every month I get a nice chunk every month, and I don't even have to trade it. So.
And what do you say to all the NFT and crypto influencers out there saying that because of this bank crash, crypto is now safer than fiat currency?
Hey, I mean, there's going to be talks like that are going to be, going around and on the social media platforms and stuff like that. And they're the crypto people are kind of laughing at, the banking people right now because, before all the banking people were like, oh, crypto is so, risky and this and that. And then all of a sudden the banks start collapsing. So now all the crypto people are laughing, right? So a little bit of back and forth with the crypto and the banking people, I think. But it kind of just goes to show that nothing is 100% safe.
Mm.
Nothing is 100% safe. I personally have crypto positions. Okay, I
Yeah.
add to my Bitcoin and ETH every month, and I have a position in ADA as well. I think we'll ultimately do well down the road. So I'm not anti-crypto at all, but I do mainly trade stocks. But I am building a crypto position that I plan on holding for the next 5-10 years easily.
Hopefully not on a shady exchange like FTX.
No. Believe it or not, a big portion of mine is in Webull. I think
There you go.
Webull's a pretty stable platform. I think
Trade it.
not
Yeah.
really any funny business on there, and that's where I keep my Bitcoin and Ethereum right now. So
That's the way to do it, especially if you're just trading it. Like, if you're not planning on like using it or
I,
using
I'm
it on
I'm
staking
buying
or
it and
whatever.
just
Yeah,
yeah.
exactly.
I'm in accumulation phase. I just
Yeah.
add a little bit every month, and I don't even think about it.
I get that. Well, I appreciate everyone for tuning in. We are at the top of the hour, so we're going to go ahead and close this one out. This is your options trading with Swinging Bull and myself, What the Duck, also known as MetaMatt to the Web3 community. But we're going to be doing this every Monday, 12 p.m. Eastern. We love if y'all came with questions on any stocks that, or options that y'all are looking at for next time. We can definitely do some deep dives and some charts for you or just any kind of option strategy questions y'all have. But thank you all for all tuning in. We will see you next time. And as always, until then, we hope that you all make some bread.
Thanks, everyone. Cheers.